Welcome to the deep dive. Ever wonder how some big companies manage their taxes so effectively? It often seems like a kind of secret sauce.
It really can seem that way.
Well, today we're pulling back the curtain on a major one, consolidated tax returns. It's this fascinating, sometimes complex financial maneuver.
And it can seriously impact a company's bottom line.
Absolutely.
So our mission for you today is simple. Decode it. We'll unpack what they are, who qualifies, the big upsides, the equally important downside.
Yeah, the catches.
Exactly. And then walk through how they're actually put together, number by number. We want to make this really clear for you.
Okay, let's jump right in then. What exactly is a consolidated tax return? Is it just like a different form you fill out?
It's much more than that. Think of it as a special privilege the IRS grants. It's not automatic.
A privilege. Interesting.
Yeah, specifically for what are called affiliated groups of corporations. And this is key. Every single corporation in that group has to agree, has to consent. It's a group decision.
Okay, so privilege, not a right. That really clarifies things. Who's definitely not getting this privilege then, according to our sources?
Well, the rules are pretty clear. S corporations are out, foreign corporations too.
Right.
Most REITs, that's real estate investment, trusts, some types of insurance companies, and most tax-exempt organizations. They just don't fit the structure required.
Got it. So if it's a privilege for these affiliated groups, what are the first steps? What hurdles do they need to clear just to be considered?
There are two core requirements. First, all the companies involved have to be members of an affiliated group at some point during the tax year. Doesn't have to be the whole year necessarily, but at some point.
Okay.
And second, each member technically needs to file a consent form. That's Form 1122. But interestingly, the act of just filing the consolidated return together usually satisfies that consent requirement.
So filing is the consent, effectively.
Pretty much, yeah.
Yeah.
And there's a deadline you absolutely have to know. The election to consolidate that first consolidated return must be made no later than the extended due date of the parent corporation's tax return for that year. Can't be late.
This affiliated group thing sounds crucial. That's where it gets really strategic, right? What exactly makes a group affiliated in the eyes of the IRS? It can't just be any bunch of related companies.
No, definitely not. It's very precise. You need a common parent corporation.
Yeah.
And that parent has to directly own stock meeting two tests for each corporation in the group.
Two tests. Okay.
Yes. 80% or more of the total voting power of all outstanding stock. A and D. 80% or more of the total value of all outstanding stock. Both conditions.
80-80.
80-80. Voting power and value. Can you give us some example from the sources? Make that web a bit clearer.
Sure. Let's say Corporation A owns 100% of B and C. Totally owns them.
Okay.
Then B and C together own Corporation D. Maybe B owns 60% of D and C owns 40% of D.
In that case, A, B, C, and D could file consolidated returns. A is the common parent, and through B and C, it meets that ownership threshold for D as well. Works down the chain.
That makes sense. And who's definitely out, even if they seem connected? You mentioned brother-sister corporations. What's that about?
Right, that's a common point of confusion. Brother-sister corporations are where an individual, like a person, not another corporation, owns 80% or more of two or more companies.
An individual owner.
Exactly. Let's use the Olinto example from our source. If a guy named Olinto owns 100% of Corp A and 100% of Corp B.
So he owns both entirely.
Yep. But A and B cannot file consolidated returns. Why? Because neither one is 80% owned by another corporation. There's no common corporate parent. That's the key distinction.
Got it. The parent must be a corporation. So with all these hoops to jump through, why bother? Why would companies want this? The advantages must be pretty significant.
Oh, they really can be. The biggest advantage is pooling. Let's say one company in the group has capital losses this year. It can use those losses to directly offset capital gains from another company in the same group. Same thing with operating losses. One company's loss can reduce another's operating profit for tax purposes. That's huge.
So you average out the good and bad years across the group, basically.
In a way, yes. And another major benefit, dividends paid between companies in the group. They're 100% eliminated in consolidation. Poof, gone. No double taxation on that money moving around internally.
Wow, okay. That avoids a major tax hit.
Absolutely. Plus, certain tax deductions and credits often have limits based on income. When you consolidate, those limits are often applied to the group's total income, which might be higher, allowing for bigger deductions than any single company could take alone.
So you unlock bigger deductions sometimes.
Exactly. Think net operating losses, NOLs. An NOL carryover from one member can potentially offset the income of the entire consolidated group. And finally, there's deferral. Income from certain sales between group members can be deferred until the item is sold to someone outside the group. Helps manage timing.
That's really interesting. It sounds like it allows companies to function more like a single economic unit for tax purposes, smoothing out the highs and lows across the board.
That's a great way to put it. It aligns the tax treatment more closely with the economic reality of the group.
Okay, those advantages are definitely compelling, game changer stuff for tax planning. But, like you said, there are always catches. What are the downsides? The things that make companies pause?
Right. It's definitely not a free lunch. First off, the regulations are highly complex. You're signing up for a lot of detailed rules and compliance work.
Complexity, okay?
Then there's a potential issue in the very first consolidated year. If companies in the group were selling inventory to each other before consolidating, you can run into a sort of double counting of inventory issue that needs careful handling. Adds complexity right away.
Tricky start.
And just like gains on intercompany sales can be deferred, losses on those sales can also be deferred. Sometimes you might want to recognize that loss sooner, but the rules might force deferral.
So deferral isn't always good.
Not always. Another big practical issue. Every company joining the group must change its tax year to match the parent company's tax year.
Oh, everyone has to be on the same calendar.
Exactly.
Yeah.
Which often means a new subsidiary joining might have to file a short-year tax return for the period before it joined, plus be part of the main consolidated return. More paperwork, more cost.
Right.
And ironically, while consolidation can help utilize deductions, sometimes tax credits can actually be limited by the operating losses of other members in the group. One company's loss could reduce another's ability to use a credit.
An unexpected interaction there.
It can happen, but maybe the biggest drawback, the one that gives people the most pause.
Let me guess. It's hard to get out of.
You got it. The election to file consolidated returns is binding for future years. You can't just switch back next year if you change your mind.
Locked in.
Pretty much. You generally need to either break up the affiliated group structure entirely or get specific, and often hard to get, permission from the IRS to deconsolidate.
Wow.
And one more thing, state taxes. Many states don't allow consolidated returns, so you might file one way federally, but then have to prepare separate returns for each company for state purposes. That's extra time, extra expense.
So double the work in some cases?
Potentially, yes. It really forces a company to ask, are these benefits truly worth the headache, the complexity, and this long-term commitment?
That binding nature, especially, combined with the complexity, it really frames it as a major strategic decision, not just a filing choice. Like a tax marriage, almost.
That's a good analogy, for better or worse.
Okay, let's dive into the mechanics now, the real nitty-gritty. We want to make this super clear for you listening. How do they actually calculate the consolidated taxable income? Let's walk through those steps.
Right, this is the engine room. It generally follows 5 main steps. Step 1. Calculate each member's taxable income on its own, completely standalone, as if it were filing separately.
Okay, individual calculations first.
Step 2. Adjust those individual numbers. You need to remove the effects of transactions between the members. Think intercompany dividends out. Deferred gains or losses on sales between members out. Inventory adjustments between members, remove those effects for now.
Got it. Strip out the internal stuff.
Exactly. Step 3. Remove certain items that have to be calculated at the group level. These are things like the group's overall capital gains and losses, Section 1231 gains and losses.
That's the sale of business property, right? Like equipment.
Precisely. Also, net operating losses, the charitable contribution deduction, and the dividends received deduction, or DRD. You pull these specific items out of the individual company calculations for the moment.
Set them aside.
Yep. Step 4 is straightforward. Combine the adjusted taxable income figures from each member, after steps 2 and 3, to get the group's combined taxable income.
Add them up.
Add them up. And finally, step 5. Take that combined taxable income and adjust it for all those items you set aside in step 3. Now you apply the rules for capital gains, NOLs, charitable contributions, DRD, etc. at the consolidated group level.
Okay, let's make this real with that example from our sources. Corporations A, B, and C filing together. A owns B and C completely. How do these steps play out with their specific transactions?
Perfect. So looking at step 2, the intercompany adjustments, the example says B paid A $60,000 in dividends and C paid A $30,000.
Right.
Since these are inside the group, they're completely excluded from A's income in the consolidation. Gone.
Okay.
Also, B sold inventory to A and made a $50,000 profit on its books. That 50K profit is excluded from B's income right now. It gets deferred until A sells that inventory to someone outside the group.
Deferred profit. Makes sense.
And C sold equipment to B, recording a $10,000 Section 1231 gain. That $10K gain is removed from C's income here because Section 1231 items are handled at the group level later.
Remove for now. Okay. What about step 3? Pulling out the group level items.
Right. Step 3. Let's look at C's charitable contributions. C paid $40,000 to charity, but maybe, based on its own income filing standalone, its deduction was limited to, say, $30,500.
Cow.
So we remove that $30,500 deduction from C's individual calculation for now. We'll revisit it in step 5.
Got it. And A's dividends received deduction.
Same process. A got those dividends from B and C, $90K total, which are 100% deductible anyway because they're intercompany and excluded. But it also got $110,000 from some other company it only owns 30% of.
Ah, an outside dividend.
Exactly. On a standalone basis, A would get maybe a 65% DRD on that $110K, which is $71,500. So the total potential DRD for A might look like $90K plus $71.05K equals $161.05Ks. We remove this entire DRD amount in step 3.
Remove it all for now.
Yeah.
Then step 4 combines the adjusted incomes. What happens in step 5 when we put those items back in at the group level?
This is where the benefits often crystallize. Step 5. Let's take charitable contributions first. Remember, C donated $40K, but could only deduct $30.05Ks on its own. Now we look at the consolidated group's income before this deduction. Let's say it's much higher, maybe $957,000, like in the source example. The deduction limit is typically a percentage of taxable income. With the higher group income, the limit is now much higher, say $95,700.
Ah, so.
So the entire $40,000 that C actually donated can now be deducted by the consolidated group. They get the full deduction, which C couldn't get on its own. That's a clear win.
That's a huge difference. Okay, what about the DRD?
For the DRD, remember we already excluded the intercompany dividends from B and C back in step 2.
Yeah.
So those aren't part of the DRD calculation now. We only apply the DRD to the dividends from the outside company, the 30% owned one.
So just the $110,000.
Exactly. The 65% DRD on that is $71,500.
Yeah.
So the consolidated group takes a $71,500 DRD.
Yeah.
It's calculated cleanly at the group level on only the relevant dividends.
It's fascinating how pooling everything together like that, applying the rules at the group level, can genuinely change the outcome. It's not just adding numbers. It's applying limits and deductions strategically across the whole group. You really see the power there.
It's a prime example of how the structure allows for tax optimization across the combined entity.
Okay, beyond the number crunching, which is clearly intense, what about the day-to-day? The practical side of filing and just managing taxes as a consolidated group. There must be compliance headaches.
Oh, absolutely. Practicalities matter. For tax compliance itself, it's actually filed on the same main form, Form 1120, that regular C-Corp use.
Oh, really? The same form?
Yep. You just check a box on page 1 that says it's a consolidated return. Of course, you have to attach a lot of supporting schedules and statements detailing the consolidation.
Okay, so the form's the same, but the attachments are where the complexity lives.
That's a good way to put it. Now, regarding accounting methods in tax years, generally each company can stick with its existing accounting method, like cash or accrual. But some rules, like whether you qualify for the cash method based on revenue thresholds, are often tested on a consolidated group basis.
So the group's total size matters for some method choices.
It can, yes. And the big one we mentioned. Every single member has to adopt the parent's tax year. No exceptions. Consistency is mandatory.
Right, the common tax year. And what about paying the bill? And estimated taxes?
This is maybe the most critical practical point. Liability. Each member of the group is jointly and severally liable for the entire consolidated tax bill.
Meaning?
Meaning, if the group owes $1 million in tax, the IRS can collect that full million from any single member of the group, even if that member's individual activity only generated a small part of the income or even had a loss.
Wow. So if one subsidiary can't pay its share, the others are completely on the hook for everything.
Completely on the hook. For the tax, penalties, interest, everything. It's a shared risk. For estimated taxes, they have to be paid on a consolidated basis, starting with the 3rd year you file consolidated.
3rd year? What about before that?
For the first 2 consolidated years, you actually have a choice. You can calculate and pay estimated taxes either on a separate company basis or on a consolidated basis. Gives you a little time to adjust, but from year 3 on, it must be consolidated payments.
That joint and several liability, though, that feels like the biggest strategic piece outside of the pure tax math. It fundamentally links the financial health and risk of all the group members in a very concrete way.
It absolutely does. It's a major factor in deciding whether consolidation makes sense and potentially influences decisions about which companies you even want in your group.
Right. Okay, so we've really taken a deep dive here. We've looked at what consolidated returns are, this idea of a privilege for affiliated groups,
Defined who qualifies with that crucial 80/80 ownership test.
explored the significant advantages offsetting losses and gains, eliminating intercompany dividends, potentially bigger deductions.
But also the significant disadvantages, the complexity, the binding election, the state tax issues, and that major joint and several liability.
And we walked through the 5 steps of calculating the income, seeing how applying rules at the group level can really change the final tax number.
Yeah, it's a powerful tool, no doubt. But it comes with a hefty dose of complexity and commitment. It requires careful planning and ongoing management.
So here's a final thought for you to mull over, building on that liability point. Given that every member is on the hook for the entire group's tax bill and you're locked into this structure, how might that reality shape a parent company's decisions about future mergers or acquisitions? Knowing that any company they bring into the fold instantly shares that total tax risk. Doesn't that add a whole new dimension to evaluating potential M&A targets, something beyond just the business fit?
It absolutely has to. The tax consolidation implications become a core part of the M&A due diligence in strategic thinking.
Definitely something to think about in the world of corporate finance and strategy. Thanks for joining us for this deep dive.